The financial media frequently portrays an interest rate cut as an immediate, universal buy signal for equities. You turn the dial down on borrowing costs and stocks go up. But historical market cycles show that prices often plummet the exact moment a central bank begins to cut rates. The assumption relies on a basic economic premise. Lower borrowing costs stimulate corporate investment and consumer spending, which mechanically translates to higher stock prices. Historical data breaks this premise. In 2008, the Federal Reserve slashed rates to near zero, providing maximum theoretical stimulus. Yet the S&P 500 continued a sustained drawdown. The rate cut did not save the market. To see why, we must examine the actual machinery inside the Federal Reserve. The central bank does not control the economy with a single lever. Congress mandates the Fed to maximize employment and stabilize prices. Today, they execute this through an ample reserves regime. Instead of just open market operations, they use administered interest rates, like the interest on reserve balances, to steer the baseline for borrowing. This baseline rate functions as one component of a broader transmission framework. Monetary policy affects the market through three distinct channels: risk-free discount rates, expected corporate earnings, and the premium investors demand for taking on risk. Reacting to headline rate cuts without calculating the net effect of these three channels traps investors in the pivot paradox. Protecting capital requires opening up the math and seeing exactly how asset prices are built. This discounted cash flow equation states an asset's price is the present value of expected future cash flows. The first transmission channel hits the denominator, the risk-free rate. When the Fed cuts rates, a smaller denominator pushes the asset value up. This chart shows three transmission channels: risk-free discounting, expected nominal profits, and the equity risk premium. Easing policies stimulates borrowing and spending, expanding expected cash flows. Finally, the equity risk premium is the excess return investors demand for holding risky stocks. Fed easing floods the system with liquidity and removes tail risk from the market. When investors feel safe, they accept a lower premium for risk. We saw this in 2020. The Fed's massive liquidity injection rescued markets by compressing the equity risk premium, driving prices up well before profits recovered. But there is a mathematical trap. If the central bank cuts rates to fight an endogenous economic shock, like a severe recession, corporate profits may contract far faster than the discount rate drops. The numerator collapses, the ERP spikes, and equities crash regardless of the rate cut. Asset prices respond to a net mathematical output of discounting, earnings, and risk premiums, rather than following the Fed funds rate in isolation. This diagram shows the foundational rule of fixed income. There is an absolute inverse relationship between bond yields and bond prices. When newly issued bonds offer lower yields, older bonds paying higher interest become more valuable. This standard yield curve steepens during a rate cut. The short end drops rapidly, while long-term rates remain anchored. This introduces duration risk. When rates fluctuate, a 10-year bond's price swings violently due to uncertainty, while a 2-year bond barely registers the impact. In a tightening regime, when rates are rising and bond prices are falling, the tactical maneuver is defensive. Investors shift into shorter duration bonds to minimize price destruction and reduce interest rate sensitivity. In an easing regime, the strategy reverses. As rates fall, extending duration allows investors to capture capital appreciation on long-term assets. To navigate uncertain transitions between the two, institutions use laddering. By staggering bond maturities across a portfolio, they continually capture higher yields as older bonds mature, maintaining liquidity without perfectly timing the rate cycle. Managing duration risk provides the primary lever for preserving capital and driving returns, while the central bank alters the cost of money. A Federal Reserve pivot initiates the economic landing phase. High interest rates act as a physical constraint. Financing costs collide first with rate-sensitive, capital-intensive sectors. Mortgages dry up, construction slows, and corporate borrowing gets shelved. Weakness in housing and corporate investment eventually bleeds into the broader economy, appearing later as reduced job openings, hiring freezes, and eventual layoffs. This flowchart tracks leading indicators. Permits lead to housing starts, which eventually stabilizes non-farm payrolls. In a soft landing, this trajectory holds steady. housing demand climbs reliably from its bottom, and employment data stabilizes. This indicates a controlled slowdown. Inflation normalizes without triggering a severe GDP contraction. However, in a hard landing, housing data produces a false positive. We see a short bounce, followed by sharp declines as structural damage takes hold. Initial jobless claims spike. Wage growth declines. Banks intensify credit tightening, locking up liquidity and forcing the economy into a recessionary spiral. Diagnosing the true trajectory requires ignoring media narratives and strictly tracking this sequence of lagging indicators, from the housing market to the labor force. This landing sequence can be interrupted by persistent inflation. High metrics force the Fed to hold rates higher for longer, avoiding reignited price spirals. When policy remains tight, the entire math of the stock market fractures. Investors are forced into a strict tactical choice regarding equity risk. This scatterplot maps equity factors across inflation and interest rates. In a high-inflation, high-rate environment, value stocks heavily outperform by generating immediate cash flows. Conversely, growth factors excel when rates are level, but are punished in high-rate quadrants. Growth valuations rely on projected earnings scheduled years in the future. As the DCF equation shows, when interest rates rise, the mathematical penalty applied to distant cash flows increases exponentially. Equity factors have duration risk, just like bonds. Holding future-dependent growth stocks during entrenched inflation forces an investor to absorb massive volatility. The macro mechanics are clear. Asset prices are driven by the three channels of the discount model. Fixed income returns are dictated by duration math, and the economic landing is signaled by a specific data chain from housing to labor. This matrix provides the actionable playbook. We map the central bank's cycle, tightening versus easing, against portfolio exposure, risk-off versus risk-on. During a rate hike cycle, the allocation shifts to the tightening risk-off quadrant. You shorten fixed income duration to protect capital, secure stability in treasuries, and overweight value equities that generate immediate cash flows. As the data confirms an easing cycle, you execute the risk-on playbook. You extend bond duration to capture price appreciation as rates fall, and rotate back into growth equities whose future earnings are discounted at a lower penalty. The objective is never to guess what the Fed chairman will say at a press conference. The goal is to stress test your portfolio allocations against multiple yield curve scenarios before the announcement occurs. Watch the hard data. When new building permits rise and non-farm payrolls stabilize, the fundamental math validates a shift in allocation. When inflation prints remain high, you hold defensive duration. Market headlines rely on panic and blind assumptions. By replacing emotional market timing with a mechanical framework of valuation models and duration risk, you secure a resilient portfolio built to extract capital from every phase of the cycle.